in the conversation with any questions or comments you might have. We're on Twitter. Just use hashtag MKTDAY. Or if you'd like, you can follow me at Dagger Nixon. Or you can email us at yourmoney@skynews.com.au. There is a plethora of ways that you can interact on the show. Let's get straight into it. Julia Lee, a great start to the trading week.
A fantastic start for the week. The market up by 1.5%, and I guess all of it on hopes of more quantitative easing in the US. Ben Bernanke's speech didn't impress the market on Friday, but what did impress is that he did leave the door open. In fact, the September meeting for the Fed Reserve now extended to 2 days to have a look at the tools available to the Fed. So September 20 will see a 2-day meeting, and that time's also going to be important because over in Europe on September the 23rd, we do see that meeting about the emergency financial stability fund as well. So that's going to be a lot to watch out for that week. Volumes are extremely light. We saw them light on Friday during the US session and light on today's market as well. Only $4.3 billion worth of stock trade changing hands, and that makes it in the top 3 lowest volume days of August so far. Not surprising that we're going to probably see a quiet day on the US tonight after Hurricane Irene struck. Most investment banks won't have their full staff back to work tonight. Not only that, we do see a banking holiday in London, so we are expecting to see a quiet day tonight on markets. But altogether, a great start for the week, and we saw all sectors trading higher. The best areas, the utilities, the property and the healthcare area.
On Jackson Hole to continue now, I suppose, up until this September 2-day FOMC meeting. I mean, is it just going to be this ongoing speculation and ongoing interest?
Absolutely. The market is banking on further easing, whatever form that takes. And of course, up till now, we haven't seen those the policies of the Fed really resulting in an improved employment situation. And I guess Trichet was quick to point that out between the differences between the US and the European stories when he gave his speech on Saturday at Jackson Hole, saying, you know, both have seen around about a 1% growth per capita since 1999. But if you have a look at jobs, the US has only managed 8 million jobs growth, while Europe has managed 14 million. So I guess he's looking at the longer term picture. The jobs really the key in the US. If you don't have jobs, well, where's the consumer spending really going to come from? There's plenty of liquidity in the system. The banks have plenty of money. They're just not lending it out. So I guess it's a question of demand for those funds. We're still seeing rates very low in the US. So the market's very closely going to be watching that September 20 meeting, a 2-day meeting to fully explore all the tools available to the Fed. And of course, with interest rates at virtually zero, it's going to have to look at some of those non-traditional methods.
Michael just described it. Which one would you find yourself in?
I guess those macro fears are quite real, and until they're dissolved, they're going to continue to be a cloud. We are seeing companies looking quite cheap, a lot of companies looking quite cheap on a fundamental basis. But of course, if you have a look at typical bear markets, then you expect lower valuations. It's not unusual to see trailing P's of 8 or 9 and then normal conditions. So it's very different bear market conditions from bull market conditions. And I think a lot of people still remember the great markets we had from 2000 to 2007. I've been looking into bear markets just to have a look at how prices respond and how the market does tend to respond, and looking back to 1973 to 1974 in terms of the US market, and every single quarter there we saw earnings increasing, and yet the S&P 500 there, actually the Dow Jones Industrial Average decreased by 56% back then. So I guess the thing here is that perception does become reality, and the fears of the market, well, they're Europe and the US, and I don't think they can be ignored.
What about the charts then, guys? Julie, maybe starting with you. Obviously, in these sort of uncertain times, many people start dusting off the technical charts and so forth. I mean, are we getting much indication or much direction from them?
I guess for technical charters, the medium-term picture still looks bearish. For the short-term picture to change, we really want to see that 4,300 point level being broken, and we saw that 4,300 level really being that peak that we saw in August. So short-term, that's going to be our target. Of course, it's the macro themes that are driving, so a very close eye on what's happening in terms of Europe, because that can bring about systemic risk. And we did see Christine Lagarde from the IMF talking about recapitalisation of European banks, in fact recommending it quite strongly. And we've seen that a little bit over the weekend, where we have seen Greece's second and third largest banks, Alpha and Eurobank, looking at a merger and a possible capital injection of $2 billion there. But Christine Lagarde saying, you know, capital injections and capital raising is probably the best way to ensure against the risk of contagion and the fragility that we're seeing in terms of not only European sovereigns right now, but also in terms of the European banks, which are very much in focus, given that we have seen swap lines reopening between the ECB and the Fed and being drawn down on. And in Greece as well, we've seen those emergency short-term liquidity measures being reactivated.